Hey, what's up, everybody? Welcome back to Investing Sucks. So today we're going to be doing the second video reviewing a investment thesis that was posted on Value Investors Club. So I did part one of this a few months ago and I got some good feedback on it. I think people really like the idea of looking into other people's investment ideas to see their thought process behind it and to kind of learn from other people. And Value Investors Club is the best place on the internet to go to do that, in my opinion. It's a community with a bunch of contributors and they do have a vetting process set up before they let you post anything. So it's not just anyone going on here posting their ideas. And you have to submit a investment idea to them, and then they evaluate it for its merits only. And then they allow you to become a regular contributor if they think that your idea is actually good. And then you have to actually contribute regularly to the website. I believe it's 2 posts every year. And they also have monthly contests where each month they pick the 2 best articles that were posted on Value Investors Club, and the winners get $5,000. So it's definitely a great resource to use if you want to learn more about the thought process that goes into researching a company and how other people think about investments and what sort of things people look at to validate their ideas before they actually, put their own money at risk. And it's also a great place to go just to get basic info on a company, because I personally have used Value Investors Club to save myself a lot of time reading about companies, trying to understand their operations and their business models. Instead, whatever company I'm looking at, I just look them up on Value Investors Club. And vast majority of the time, you're going to get a pretty in-depth write-up on them that's in-depth, but it's also succinct. It's not super long. We can see this entry we'll be looking at is really only about a page and a half long, and they do provide good descriptions of the business. So it's a really easy way to just save yourself time and just go on here, read about the business, see what someone else already, spent the time doing to look up their operations, how the company works. So it's a great resource for that. And it's also completely free. So that's obviously nice. So I definitely recommend checking it out if you haven't already. But the company we're going to be looking at today is LendingClub. So this person is going to tell us why they think LendingClub is an extremely attractive risk reward long position. And they're saying it has less than 25% downside in an extreme economic scenario and over 130% upside in the base case over the next 6 to 12 months. So that's a pretty bold prediction there. And some of you may have heard of Lending Club and what it is before. They're kind of considered one of these fintech success stories because they went public in the year 2014 and have actually managed to become profitable since then, which is pretty rare for, fintech companies. A lot of them struggle to reach profitability and some never do. Some just end up getting acquired by another company before they go public. But this one has actually managed to do it. And they were originally a peer-to-peer lending platform where you would have borrowers looking for money and investors looking for a return. And you could also buy and sell loans on their website. So how it would work is Lending Club would originate the loans from people who would need them. And we can see some of the purposes that they have here. Usually it's to consolidate credit card debt. And people would just, if they have credit card debt, obviously the interest rate on that debt is going to be extremely high. So they would come on here and they would, get a loan, a personal loan from Lending Club. That loan would have a much lower interest rate than whatever interest rate was on their credit card debt. So they could really save their credit scores by using it. So you would have people looking for loans and then investors would come on looking for a return. They could also buy and sell loans on the platform. And how Lending Club would make money is they would take a cut of the transactions and also they would take origination fees. So that's how the business was before. They were really designed to help the average consumer, help people's credit scores. But since then, the business has actually changed quite a lot. It was in the year 2020 and early 2021 when they actually shut down the peer-to-peer lending aspect of the business, probably because they were having a tough time attracting investors onto their platform, and also probably just because it wasn't really a viable business model with the amount of money they had to spend on their staff and also marketing to get people to come to their website just so they could get these small transaction fees when the loans exchange hand or when a loan is originally originated. It wasn't really a business model that was working, and they only recently became profitable. And it took them completely revamping their business to actually become profitable, which when we look at the article, we'll get into what they actually did. But in short, they made a big acquisition of a company here, Radius Bank or Radius Bancorp, which allowed them to basically get their banking charter so they could continue to offer, or they could start offering traditional banking products like deposit accounts and whatnot. And the loans that they originate, instead of just having to immediately sell the loans or securitize the loans to outside investors, which relies on you being able to find investors for these specific type of loans in the first place, these unsecured personal loans, which in a time of an economic downturn, that becomes much more difficult. Now that they actually have their banking charter, they have the option to either securitize the loans, so sell them to institutional investors, which they don't do personal investors now, they just look at institutional investors, or they could retain the loans on their balance sheet and earn the interest income, which I think for them makes a lot of sense because earning interest income versus earning just transaction fees or origination fees for originating the loans, it's night and day. It's a completely different business model, and you earn a lot more money by collecting interest income, right? That's how all these banks that are super profitable, that's how they make their money. So really what happened was LendingClub went from this, small fintech company that I guess had all this growth potential and went public, but wasn't actually profitable, to now being profitable and being essentially a bank. After this acquisition of Radius Bank that they said here, they are in effect a bank. I wouldn't consider them a tech company anymore. I would 100% consider them a bank that just specializes in unsecured personal loans and just happens to securitize a lot of the loans. And as we'll see later on, or I could show you now in their most recent quarterly filing that's here, which is as of June 30th, we can see their non-interest income. So this would be the income that they generate from their marketplace. So like I said, origination fees, servicing fees on their loans. It is 213 million here, and their net interest income is about half of that, 116. But if we look at what it was in the prior year, it's changed pretty drastically, right? We can see here their non-interest income was more than 3 times as much as their net interest income, but now it's less than 2 times. So net interest income is growing very fast with them. And the reason that's happening is because they are becoming more of a traditional bank, and they're moving away from what they were before, which was, just this fintech company, which it's an interesting trend. And it's a trend that we're seeing play out pretty much across the space with fintech companies. As we saw SoFi Technologies earlier this year, they received their banking charter so they can begin offering traditional banking products, which is a big game changer for them because as a bank, you have to acquire funding in order to go out and make these loans. And one of the cheaper ways to acquire funding is by offering deposit accounts as opposed to relying on other banks to get loans from. And then you basically take the money you receive from the loans and then you loan it out at a higher rate and then make money on the difference. It's much cheaper and much more profitable if you're able to get deposit accounts, but of course that requires a banking charter. So what these fintech companies have been doing is they've been getting their banking charter by acquiring other banks. And it's a trend that's been happening for a while now because new banking charters aren't exactly being issued. It's pretty rare that a new banking charter will be issued. So the way these fintech companies do it is just acquire an already existing bank. Okay, but that's enough about the background of the company. Let's actually dive into the article and hear what this person has to say about them. So we already talked about this here. We've talked about the business as well. They provide a few additional details on it where they're talking about the US credit card market. It's a $1 trillion market, which, I mean, obviously there's going to be some competition for LendingClub in this market. I don't imagine they're going to be able to capture all 1 trillion, or else they would be extremely undervalued. They're saying they have 4 million members. That's a lot of members. And what they are used for is to consolidate or refinance credit card debt. And it issues personal loans in the $1,000 to $40,000 range with an average life of 1.7 years and a range of 1 to 5 years. They originate their loans through online advertising, direct mail, and social media. And it has a two-sided marketplace, like we talked about, where there's the institutional investors and the people that come on to look to get the loans, where they earn origination and servicing fees. And then since they made that acquisition of Radius Bank, they now retain the loans on their balance sheet and earn interest income, which, like I said, I think is much more profitable and is probably why they've recently been able to turn a profit, because they went from being a fintech to an actual bank, which banks are objectively more profitable. So it's been written up 3 times previously on Value Investors Club, and the last time was 2019, which was before they made that acquisition. So it's gone through a very, very significant change since then. If we look at the stock price as well, we compare it to what it was, say, halfway through 2019 versus what it is today. It's pretty much more or less the same. We can see $11 per share currently here, and then back here, it's actually lower than it was back then, which is interesting because they are such a different business today than they were before, and they're actually making money today, and they're a much larger business. So just speaks to how quickly the sentiment around a company can shift. And sentiment has turned pretty sour on Lending Club, as we can see here in the past year. They have gone down very, very significantly, 75%. So obviously, this person thinks they're undervalued, so let's continue reading and see what happens. They talk here about the acquisition of Radius Bank and how it was a game changer. We already talked before about how they can now retain those higher yielding unsecured personal loans, and they can fund them with low cost deposits, which reduces their reliance on third-party funding, which can be volatile in times of market distress. So that is 100% true. Lending Club having the ability after this acquisition to both sell their loans and keep their loans to earn the interest income. It's a huge benefit versus just needing to sell the loans, because demand from investors, even institutional investors, is something that's going to fluctuate, and it will be especially bad in times where sentiment on the health of the consumer is very low. And investors probably won't be interested in investing in a totally unsecured loan to individuals during a time of a potential recession, rising interest rates, high inflation. Those sound pretty risky, and they would want to be compensated for that risk with a higher return. So again, I definitely agree the company is very different than it was today, even though the company is very different than it was back in 2019, even though the share price, as we saw, hasn't really reflected that. It hasn't changed a whole lot, which is interesting. And like I said, the amount of money that they can make as a bank is much more than as a fintech. But of course, the other side of that is, now that they are a bank and they're holding those loans, they're exposed to losses, right? Which means they need to develop a robust risk management practice to not lend to people that aren't ultimately going to pay them back, because that's really what banks are doing. They're doing a risk balancing act where they have to take on enough risk so that they can actually turn a profit, but not too much risk where so many of the loans that they make aren't going to get paid back and they just end up taking massive losses. So they've only been a bank for a little while now. So there is the risk that maybe they don't have as robust a risk management process as, say, a JP Morgan would, which has obviously been around for, hundreds of years now. So that is a big risk that you run with this company. But onto the valuation side of it, we can see the company is highly profitable. They're trading at 6.5 times 2023 earnings estimates, their 2023 earnings estimate, and 1.3 times price to tangible book value. So tangible book value is just book value, but you exclude intangible assets like goodwill. So, I mean, that is still relatively high for a bank. I mean, 1.3 times price to book value, that strikes me as a little bit high, just because of what this company is now, and also what's going on in the economy, how consumer sentiment is very low with high inflation, rising interest rates. So these loans are now much more risky. And because the company is now exposed to losses, they are probably going to have to deal with some of those losses. And that's probably why we've seen this company's share price turn so sour. And actually, one thing I want to do real quick is compare the market cap with the company's book value, just to see what sentiment has actually been like for this company. So we'll compare these two and then zoom in to see what it's been like. So yeah, if we go back to, I guess, middle of 2021, these were very, very detached from one another. We can see green is the company's market cap, purple is their book value, and they've converged quite significantly since then. So that's probably the changing sentiment around the business, where they're now more of a bank rather than a fast-growing fintech company. Although, as we'll see in this article, and one of the things that they mention is Lending Club is growing their originations and their revenue in the mid-20s range. So they are a bank, but they're a very, very fast-growing bank, which would make them worthy of a higher price-to-book ratio, because that book value is going to grow because they continue to make more loans, become more profitable, and they have a significant runway to take market share in the $1 trillion credit card market. So this is especially true in the US. And they go on to say credit card debt is a significant problem, and they're positioned to be a solution. I would definitely agree with this. They are a solution. I'm sure there's also other companies that are solutions and other companies that are solving this problem. But I pulled up this, which shows some basic credit card stats, and it's showing the average credit card debt per person for each country. And we can see in the US, it's extremely high. And for whatever reason, credit cards are just well ingrained into consumer culture in the US. Everyone in the US has multiple credit cards that they use regularly. Everything people buy is typically on credit. So credit card debt in the US is high. And it's much higher than what we see in what I would consider somewhat similar economies like Canada, United Kingdom, even Japan, an advanced economy. they're obviously an outlier here. So for whatever reason, I guess that's just how it is in the US. People use a lot of credit card debt. But let's continue on. The company is still able to grow originations at this pace despite tightening their underwriting standards and purposefully slowing to be conservative and improve customer profitability. So they have to do this now that they're a bank. They can't just lend to anyone because they no longer have the ability to just sell those loans to other investors that are willing to take on more risk. If they're going to originate a loan, they have to also be willing to accept the fact that maybe they'll have to hold that loan on their books and collect it for however long it lasts. So they do have to be more stringent with who they decide to lend to, which, like I said, I mean, it's gonna tighten them, but it's gonna make them more profitable as an entity. So they're becoming more like a bank. That's what I'm kind of getting from that. And they're also expanding into auto loan refinancing, which I guess that's a different market for them. And LendingClub has a high net promoter score. So this is something that's used. There's some formula behind net promoter score, and I know 100 would be considered perfect, I think. Don't quote me on that though, but 79, I guess that's high, where the average bank is a 34 net promoter score. That just means that their customers like them. Over half of the company's customers return to get a loan within 5 years of their first loan. So I guess that's good. You know, they have repeat customers, and they're talking about the referral business to drive down marketing costs. Now, this I don't really agree with because there's lots of businesses out there that have referral networks, right? And that's just because customer acquisition in the finance space or in the fintech space is very, very expensive, right? I mean, you have companies like Tangerine, Simple that are quite literally paying you, they're giving you free stocks just to sign up for their platform and open an account with them, right? That's not done by accident. And in addition to that, they're also paying money to market the fact that they're willing to give you money just to sign up with them. So the reason they're doing that is because the value of an additional customer in this space is so high because I guess with LendingClub, they would earn interest revenue, which, as we've discussed now, is very profitable. For these other companies, if they're able to, say pay you $60 just to sign up for a checking account, they can do a lot with the money that you deposit with them, right? Because it's low cost financing for them. So customer acquisition is always going to be a problem for them. It's not something that I don't think it's going to get any better. I wouldn't really call it a network effect. And if we take a look at their balance sheet, or not their balance sheet, their income statement, we can actually see what their marketing costs have been. And you're going to see that it is probably going to be pretty high. So we go down here, we can see, so other than compensation and benefits, marketing is their largest cost item here, $61 million. And they were still profitable off of that. But that just goes to show, marketing is going to be very important to this company, and it may decrease relative to the size of the money they're making in revenue if their revenue outgrows that, but it's not something that's ever going to go away. They're always going to have to continue to invest in marketing. So why they're saying the business is understood, they're saying, as we discussed, their share price sits at the same level it averaged in 2019, despite a huge change in the business. And short interest has ticked up recently and sits at 88% of the outstanding float. So people are probably shorting it because they're just bearish on the health of the consumer, and they see this company as one that is basically a pure play in the US consumer. So if things like high inflation and interest rates really hurt the consumer and we go into a recession, then this company is going to face a lot of losses because, as we've seen, they only provide unsecured loans, which, if they're unsecured, there's no collateral that they can have in the case that people default. If people default, then they're just SOL basically. So now they're saying in their base case, they believe, so this is going on to the valuation now. Now they're saying in their base case, the company is worth 15 times price to earnings or 2.5 times price to tangible book value, which implies a $33 price target or 130% upside potential. And they're saying this seems conservative given their 25+% growth in deposit funding, unique market-based business, network effects, and 4 million members. So I wouldn't really agree with this PE ratio. I think this is way too high because you have to look at the company for what it is, right? They're no longer a fast-growing fintech company. What they are is a bank that specializes in a very risky subset of banking, unsecured personal loans, but they are growing fast. So you have to give them some love for that. They are growing their deposits fast. The business as a whole is growing fast, and it's now actually profitable. But at the end of the day, you have to value this company based off of what similar companies are like it. And because their loans are so risky, and we are in a time where consumer sentiment is low, and these loans are more riskier than they were a year ago, that's for sure. I wouldn't give them a 15 price to earnings ratio. I would say maximum I would give them, just off the top of my head, would be 10. Most banks that have some security on the loans they offer, like mortgages, for example, there's the collateral in that there's an actual asset, the house behind it, would trade for less than a 10 to price to earnings ratio. So I do think that this is conservative, even given how fast they're growing. But then another important point, which I'm going to skip to later in the article here, which I think this should have been mentioned earlier, is that they exclusively lend to prime customers. So on their balance sheet, their customers have an average FICO score of 720 to 730. So anything kind of in the mid 700s range of a FICO score is like near perfect. That would be a prime credit customer. And their NPLs, which is non-performing loans, and charge-offs. So these are basically loans that go into default and they can't collect them, has consistently lagged industry peers. And this is an interesting trend that's been developing for about a decade now. Just charge-offs and non-performing loans, so people not being able to pay back their loans across the whole banking sector has been decreasing and decreasing for 10 years. And it's something that's probably going to reverse. If you look at the commentary that other banks are releasing, especially since a lot of banks are recently releasing their Q3 results, they're all saying that they expect this to reverse in the future and that there's going to be more defaults, so more of these non-performing loans in the future. So I think discounting that and just saying that it's lagged industry peers as the assumption that that will continue, I think that's a bit of a risky assumption, but it could be true. And the last part of this article that I want to point out is where they're talking about what their downside scenario is. So they say, I believe tangible book value of $11, 25% down, is a realistic downside in an extremely bad market sell-off. So I don't really agree with this. I think in an extremely bad market sell-off, this company their market value drops well below book value, right? Because if a lot of the people are defaulting on their loans, they have no security to back up their loans, then people are going to look at their loan book and say, well, the book value consists of all these loans, which are probably going to end up being bad if the economy, goes into a worse recession than it's already in, and inflation stays high, and people just don't have the ability, even prime customers with higher FICO scores, even if they can't continue to pay down those loans, that would be really the worst case scenario I could imagine for this company. So that's what personally puts me off from this company, is that the downside is extremely, extremely bad. I mean, the downside I could see, which isn't even that unrealistic of an assumption, is if basically the company goes bankrupt, because so many of their loans, which they have, I believe, a few billion in loans. We can take a look on their balance sheet here. Uh, yeah, we can see loans and leases held for investment as of their most recent quarter is 4 billion, and these are all unsecured from what I can tell. So in an extremely bad economic scenario, a lot of those are not going to end up being paid back, and the company could drop well below book value because their book value is going to fall because those loans are going to have to be written off. So I think they are optimistic in their assumptions, but overall the general point they're making, I think, is still valid, because they're basically saying that this company has such strong growth potential. I mean, they're operating in a market where there's clearly a need for what they offer, consolidating the debt of US consumers, and they're valued relatively cheaply compared to how fast they have historically been growing their loan originations and their profitability. But the issue with growth in general is you can only speculate how long it'll last for, right? And it has been proven through academic research that companies that have recently had higher growth rates tend to be misvalued by retail investors, or just investors in general, because people have a tendency to project unreasonably high growth rates into the far future for these companies that have recently had high growth. So that is the risk. That's not what I'm saying is going to happen here, because maybe the company continues or even exceeds the growth projections. That's still a possibility. So the way I look at this company is the range of outcomes that could happen in the future is very wide. You either have the extreme downside, which is, in my opinion, the company goes bankrupt because they can't afford to take all the losses on their loans. Or you have the extreme upside, which is they get through this recession okay, they come out on the other side, and they continue to grow at a super fast rate, and their profitability shoots through the moon, and the company becomes worth multiples of what it's currently worth now. So this is a risky one, I would say. It's one that I can definitely foresee paying off, but not one I would personally invest in, just because the downside is very, very risky, in my opinion. But anyways, guys, that pretty much does it for this video. So please leave a like if you enjoyed this, and let me know if you'd like to see more of these types of videos where I kind of just ramble off the cuff about, opening thoughts I have about an investment thesis. If you're new to my channel, then I'd appreciate it if you would consider subscribing, and I'll see you guys in the next video.